What's up everyone, it's Scotty with MoneyVest. So in this video, we are going to be talking about Johnson & Johnson, ticker symbol JNJ, and it's a very similar company to what we analyzed earlier, which was Procter & Gamble. And these are very defensive, very staple stocks that are in the sort of consumer goods category that have a pretty significant total addressable market because they operate in so many different industries within an umbrella of all the brands that they carry. But they're also underperforming, right? So in 2023, they haven't really seen a lot of momentum. A lot of the liquidity is kind of flooded more towards technology, growth, big tech. That's where the money's gone. And a lot of these companies have mostly traded sideways, right? So Procter & Gamble, as we learned earlier in my previous video, is down, I think, a little bit over 5% year to date. Johnson & Johnson is down over 12% year to date. And the overall consumer staple sector is also underperformed. It's down a little bit over 2.5% on a year-to-date basis. So we're going to break down these companies, figure out, okay, if there's been so much underperformance, and 2024 could be one of those years where there is a potential recession, are the markets going to actually rotate into these staple stocks, right? Is there going to be an opportunity in these defensive sort of staple sector, which A, has underperformed, B, the market's kind of shaping up to take some profits off the table, de-risk, and maybe flood into this area, and C, of course, there's a possibility for a recession as well. So hope you guys enjoyed this video, find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. I would really appreciate that. And again, links to our Discord and Patreon is going to be down below if you're interested in joining, and of course, getting access to all the members-only private videos, Excel spreadsheets, and all the trade alerts, including buy and sell alerts, options alerts, trade ideas. Everything's going to be included. And also do check out the Christmas sale on all the courses, coupon code Santa Rally. You can get up to 50 to 60% off on all the courses that are available. Lifetime access with the link down below. And definitely do check out my Instagram. My handle is going to be CastWRP. You can connect with me there also if you're interested in getting some behind the scenes videos, of course, polls and strategies. I share my portfolio updates over there as well. So all the links are going to be down in the description below. So when it comes to Johnson & Johnson, a very, very significant brand for consumer items, healthcare items, different pharmaceutical products as well. 60 straight years of increased dividends. So it's a dividend aristocrat. It's a blue chip company, $17.7 billion invested in mergers and acquisitions. #1 rank for Fortune's most admired company list for the pharmaceutical industry, and 29 brands and platforms with more than $1 billion in sales in 2022, and 3 number of companies in the world with a AAA credit rating, including Johnson & Johnson, and $14.6 billion invested in research and development as well, and 65% of 10-year free cash flow returned to shareholders, basically doing a lot of dividends and share buybacks as well. This right here has been the performance. So it has not actually performed as well as the S&P 500. Now, I don't know if the dividends are included because the company does pay a reasonable dividend. If you come over to Johnson & Johnson, we've got a dividend yield of a little bit over 3%. So that's actually pretty good. So I'm not quite sure if this actually does include the 5-year shareholder return. I'm assuming it does include dividend, but it has underperformed the S&P 500, the S&P pharmaceutical sector index as well, which are both higher in terms of their 5-year CAGR returns versus Johnson & Johnson. Now, when it comes to the third quarter fiscal year 2023 highlights, which were the most recent earnings, sales were up to as much as $21.4 billion. That was up 6.4% year over year. GAAP earnings came in flat on a year-over-year basis, just over $4.30. GAAP EPS, however, was a little bit higher at actually $4.3 billion, so not a lot of change. And because of the share buybacks, a GAAP EPS was slightly higher to $1.69, up 4.3%. And adjusted EPS was $2.6 per share, so a little bit under $3 a share, up almost 14%. On a year-over-year basis, and adjusted earnings came in at just over $6.8 billion, which was again 14% higher on a year-over-year basis. And adjusted net income was a little bit over $8 billion in 2023 third quarter, which again was higher than compared to $7.1 billion same time last year. Innovative medicine, medtech, and of course, expenses not allocated to segment, but these two right here are the main sort of contribution mix, with 45% coming from innovation, medicine, and of course, medtech making up under 25% for the company as well. Now, when it comes to the cash and marketable securities, $24 billion of cash and marketable securities with $30 billion of debt. So they are sitting on about $6 billion of positive net debt. So that's not the best place to be because they do have more cash than debt on the balance sheet. And debt to free cash flow, if you take 30 divided by 12, we're looking at a little bit less than 3, which is good. And that's exactly what we look for when it comes to the balance sheet metrics for any business. Now, when it comes to 2024 considerations for innovative medicine, they've mentioned that they are confident in their ability to deliver growth from key brands and continued progress from newly launched products. So this is going into next year. When it comes to medtech, growth and enhanced competitiveness driven by new products and commercial capabilities, and expected 2024 procedure volumes to remain consistent with 2023 levels as well. And again, a lot of that is obviously going to depend on interest rates as well, because InMode also kind of delivers these capital equipment machines for surgeries, cosmetic surgeries. And of course, their demand has kind of tapered off because of the higher interest rate environment that we're currently in. So if interest rates start to roll off, there's going to be more surgeries, more procedures, more financing, more demand, and that can of course lead to a higher, more stronger 2024 for a lot of these companies. Now, when it comes to the overall total addressable market, right? So it is going to be broken down between three different ones. So pharmaceuticals, $1.3 trillion in 2023, which includes areas like immunology, oncology, neuroscience. This segment contributes to the largest portion of the overall TAM for Johnson & Johnson. Medical devices, which is around $500 billion, and consumer healthcare, which is estimated to be around $400 billion in 2023. So give or take, we're looking at just over $2 trillion in total addressable market for Johnson & Johnson. Now, when it comes to the overall revenue, so as mentioned earlier, very similar to the Procter & Gamble analysis, this is not like a super high growth technology or software business where we can see 20-30% growth in revenues every single year. It is a very, very slow growing, modest, staple business. So even though the revenues are up from $71 billion to $98 billion, the growth rate obviously is a lot lower than compared to a technology company, but it's still very, very strong growth in my opinion. And gross profit up from just under $50 billion to over $66 billion. And operating income is up from $19 billion to well over 27, almost $28 billion for the company as well. When it comes to net income, so that's gone from 13, a little bit under 14 billion to well over $34 billion on a trailing 12-month basis. So very, very nice consistent growth there. And of course, we have seen shares outstanding gone down from 2.877 to 2.6 billion. So about 200 million shares bought back over the years, and dividend per share has increased from 259 to over $4.64. So very nice consistent dividends given out to shareholders, not to mention free cash flows, EBITDA, net income, everything has also grown over the years. Now this right here is going to be the balance sheet again. So again, current ratio is at 1.21. Quick ratio when you take inventory out is a little bit under 1, but barely under 1, so that we can let that slide. Cash is less than debt here, as we discussed earlier, but by $6 billion, and debt to free cash flow is indeed good. This is not the correct calculation in my opinion, because free cash flow is a little bit higher than what the debt level is. Well, it's still lower than the overall debt, but debt to free cash flow, when you take that division, it is a little bit under 3, which is what we look for. Now, when it comes to valuation, now valuation is, in my opinion, quite suppressed on a non-GAAP basis. We're looking at 14, 15 times earnings multiple, with the price to sales sitting at just a little bit over 4, price to cash flow at over 15 to 18, with enterprise value to EBITDA sitting at just a little bit over 10 to 11 times for the company as well. So we got somewhat of a reasonably low valuation here for the company at the moment, considering that it hasn't really performed in a little bit over 2 years. And now when it comes to the margins, we're looking at very good margins. In fact, if you take a look at the operating leverage and efficiency for the company, it's absolutely stellar, because we're looking at incredible return on capital, return on assets, and equity margins at over 19 to 20%. We've got free cash flow margins at over 21%, net margins at 35%, gross margins at 67%, and more importantly, if you take a look at profit per employee, so net income per employee, $226,000, so almost $250,000 per employee in profit. That's actually very good compared to the 5-year average of $122,000. So that's more than doubled. Almost doubled in the last, on a 5-year basis, 5-year average basis. That just goes to show the company is becoming more efficient over time, and operating leverage is starting to kick in. This right here is going to be the forecast, so $9.92, so a little bit under $10, expected to go to $13.35. That's going to be a reasonable growth here. So if you plug in these numbers into the spreadsheet, we're looking at a growth rate of just over 3%. So that is not like a super exciting growth rate, but again, that's what you'd expect from a consumer staple business, which is very, very sort of in the defensive sector. So if you plug in these numbers, let's just call it $10 per share in EPS, and we're looking at $2.6 billion in diluted shares outstanding. So we're looking at just about $26 billion in overall net income for the company. So $26 billion. Growth rate, let's just assume 4%. We're going to go with about an 18 times price earnings multiple. The discount rate can be 9%, considering that the dividend yield is very high at over 3%. 10% margin of safety, and minus 1% share buyback, we get to a fair value of about $145. And it's trading actually very close to its intrinsic value, only 6% away from its intrinsic value. And this right here is going to be the entire sensitivity grid, where you can take a look and figure out for different growth rates and different price earnings multiple, what is the best value for Johnson & Johnson. So right now, considering that it's at 154, we're probably over here somewhere where the market maybe is pricing in maybe slightly higher margins, a slightly higher sort of price earnings multiple, even if there is a low growth rate. But if we go down the growth rate, let's say 156 over here, the market may be pricing in a slightly higher growth rate of 8% over the next 5 years. So for me, I think 145, anything under 140, 130 will start to make a lot of sense from a fundamental standpoint. And this right here is going to be the technical analysis, where we've got a lot of supply over here at this resistance at 171, 172. We seem to be consistently getting rejected at that level, and a lot of support here for Johnson & Johnson. That's going to be sitting roughly at 144. That's exactly where my fair value is on the business. That's going to be closer to $140, $144 per share for Johnson & Johnson. Of course, a lot of consolidation sideways in that range for this company, with a resistance all the way up here, and of course support level sitting all the way down here. So that's where we are with this company. It hasn't really moved much in almost 3 years. It's at the same price as it was in January of 21. So let me know in the comment section down below, what do you think about Johnson & Johnson? What are your thoughts? And this right here, again, is going to be my intrinsic value closer to 145. Anything sub 140 even in the low 100s would be ideal, because we're trying to buy something which is undervalued, right? We don't want to get something that's fairly valued. We want to get something that is indeed undervalued. So a much stronger support, and an area where I would be a lot more interested in looking into this company in more detail is going to be at closer to 124 and lower. So that's going to be another very important support level to watch for Johnson & Johnson. Make sure that you drop a like, subscribe to the channel. Definitely do check out the Patreon and the Discord link down below. Santa Rally is a coupon code for all the courses that are available on sale, 50 to 60% off for Christmas until December 28th. And definitely do check out my Instagram, connect with me there. And as always, happy investing, and I'll see you all in the next video.